Hello, in today's video I'm going to cover the US regional banking crisis, which has impacted markets recently. I'm going to cover what has happened, why did it happen, and most importantly, what does it mean for you? For some, Silicon Valley Bank's collapse triggers memories of the 2008 financial crisis. Having discussed the impact and potential impact with fund managers and research companies such as Elston, we believe that whilst the market remains volatile, there is no indication of wider global issues. These recent events are a reminder of the importance of having a well-diversified portfolio. So, what happened? In the last week, Silicon Valley Bank and Signature Bank, both US regional banks, were declared insolvent. This was the first banks to fail since COVID and one of the largest banks to collapse since the global financial crisis. The US central bank acted swiftly to seize control of the bank's assets and to keep the bank open for business. I doubt many of you will have heard of SVB. This was the bank of choice for tech sector startups in Silicon Valley. Similarly to Northern Rock, the news that there was problems created panic amongst depositors, that they wouldn't get their money back. The trust in the banking system was at stake over last weekend. However, the Fed acted quickly to protect deposits and to maintain faith in the banking system in general. So, why did it happen? SVB was a niche bank that was focused on tech startups. As a result of their success, there were large inflows to the bank. The bank kept a small amount of cash and used the remaining funds to lend to other companies and to invest in safe assets such as US government bonds. This is typically how all banks function. The impact of last year and the Fed's raising interest rates to fight inflation caused bond yields to rise, which had the impact of bond prices falling. This, as you would imagine, had a dramatic impact on the profitability of the bank. As news broke, a run on the bank developed as people rushed to withdraw funds. Panic led to more concerns and the issue escalated. So, why does this matter? It's common practice for banks to hedge any such interest rate risks on their investments, but SVB was unusual and irresponsible, and it did not hedge this interest rate risk. This created a large unrealized loss on its bond holding. Ironically, SVB's chief administration officer, Joseph Gentile, worked as chief financial officer at Lehman Brothers Global Investment Bank. He left Lehman Brothers in 2007, just 1 year before it went bankrupt in 2008. As the bank needed to maintain a minimum asset base, when SVB announced they had to raise additional capital and issued more stocks and bonds, when they failed to attract investors, this created more panic, selling its shares. SVB shares collapsed more than 60% on Thursday and are now worthless. The killer blow was depositors realised that they may not be able to get their money out, and this triggered a classic bank run as everyone rushed to get their money out of the bank at the same time. SVB bank reserves were not sufficient to cover all withdrawals, and it ended up being declared insolvent last Friday. The question you might ask is this another global financial crisis? It's certainly been a crisis for SVB, and as a result, all US regional bank share prices have been impacted. But we don't think there's a risk of global contagion. There are separate concerns around Credit Suisse's financial position in Europe, which may be resulting in a forced merger, but that is entirely unrelated. Bank failures, in fact, are much more common than people think. Since 2009, there have been 513 bank failures in the US, and the banking system is well equipped with dealing with the failure of poorly managed bank. But what is true is the relaxing of the stringent post-financial crisis rules and controls for the US regional banks have left them more exposed to poor management and this sort of impact. This is why US regional bank shares decline so dramatically. So, what happens next? In light of recent events, bond yields have collapsed and broad equity markets in the US and Europe have sold off. But the pain has primarily been in US regional banking stocks. Market conditions remain uncertain, but we believe that since the Fed has put a backstop in place, this would not result in a long-term structural issue. Looking ahead, the market is now pricing that the Fed will cut rates instead of rising rates further. Ironically, this mid-banking crisis in regional banks acts as a form of financial tightening, which is what the Fed was trying to achieve with its higher for longer policy. Once the dust settles, we believe that the Fed will continue its efforts on reining in inflation once these financial stability concerns have subsided. In this case, the Fed's intervention to support its customers prevented a domino effect from spiralling out of hand. Overall, we think this episode shows the importance of a broadly diversified investment portfolio, such as those that we offer at Wealth of Advice. As we navigate through this challenging time of above target inflation and high interest rates, it's very much important to stick to these basics.
Following on from Matthew's update regarding what's been happening in the US banking sector with Silicon Valley Bank, there's obviously been lots of headlines this week about what's been going on with Credit Suisse and the European banking market. Myself and one of our power planners, Jay, have just today been at a seminar where we've heard from Morningstar, which is a big US investment research company. We've been hearing from them and lots of other research companies and fund managers lately, speaking with Elson Portfolio Management this week, hearing from T. Rowe Price, Legal & General, HSBC. And we've been trying to find out what is that's going on in the banking sector to provide reassurance for our clients. The issues that have happened with Credit Suisse, that's been more of an ongoing issue for the past 2 or 3 years. Credit Suisse have faced numerous challenges over the past couple of years, such as money laundering issues, high-profile departures. 2021 and 2022, the bank was loss-making, and again they've announced that they won't be making any profits this year. We're showing a chart now which shows you Credit Suisse's share price. Over the past 5 years, the share price is down over 85%. Now, you might be thinking, is this going to become another global financial banking crisis like we saw in 2008 and 2009 with the likes of the collapse of Lehman Brothers and Northern Rock? Speaking with various fund managers, we don't think that's the case. Just yesterday, which was Wednesday, the 15th of March, UK and European stock markets were down quite a lot. The FTSE 100 was down, I believe it was about 3.8% over the day. European and UK markets have a high allocation to banks and financial companies. Obviously, when this type of news comes out about a bank, there is kind of a bit of panic in markets, and across the board, other banks have seen their share prices fall. That doesn't mean that they're facing the same issues. This morning, there was news that the Swiss National Bank, which is the central bank in Switzerland, have stepped in to support Credit Suisse with a $54 billion loan. This has helped reassure markets, as the Swiss National Bank have basically come out and said that they're going to help prop up Credit Suisse. Obviously, the situation is evolving day to day. We are monitoring this as much as we can, speaking with as many fund managers as we can, and we will keep you updated as the news keeps on coming out. We hope that you found this video useful and reassuring. Obviously, if you do have any questions, please do just reach out to your advisor. We are here to help. Thank you for watching.